Hello, do you ever get confused about any of these different elements of finance? Loans, overdrafts, credit cards, hire purchase, PCP. There's a whole raft of them. There's a whole raft of other ways that you can finance your living or purchases, and they can all get quite confusing. So today I'm going to go over the top kind of 5 ways that I see you can finance any kind of deal, purchasing, cost of living, help with your cash flow, and I'm going to cover the benefits and the pros and cons of basically whether you should be using them, the basic concepts of understanding those, and what pitfalls to avoid when using any of those. Let's do it. Hello everybody, Adam Marif here from Beyond Educated. If you've not been to my channel before, I am a channel that focuses on health, productivity and well-being. Thanks for stopping by. Please do me a massive favour and give this video a big thumbs up, click that like button, turn that like button blue. I don't normally dress like this, but I thought I've just come back from work, and seeing as the topic is finance related, I thought I would stay in my suit to look the part of the more professional financier. Okay, so without further ado, let's get on with the topic of finance. Okay, let's face it, so there always comes a point in our month, in our life, whenever we get to a certain stage and we've either run out of money or we need additional financing to fund either bills or purchases and any kind of spending. Maybe that's feeding the family or whatever it is, and there's a whole raft of different ways that we can end up doing that through credit cards, loans and overdrafts and all these different type of things. I'm going to do this with the help of my trusty whiteboard. The first one that we're going to cover is going to be loans. Very simply put, a loan is an advance on cash to you, generally provided by a bank or an institution. Their loans tend to come with an APR, and I'll explain what that is. So the APR, very simply, comes as a percentage. It's similar to interest, but it's slightly different. They tend to be, now with market rates, vary between, say, 3 and, I don't know, 12%. That's very high. That's kind of very low base end, and it will depend on your credit score. The APR accounts for the interest that you'll pay over the year based on the sum of money that you're going to borrow. Now, APR can be a little bit complicated to work out, but we're not going to go into too much detail. Essentially, it accounts for the fact that if you borrow £1,000 over the year and you pay £100 back every month, the amount you're borrowing is not £1,000 because you'll only have borrowed £900 after month 1, £800 after month 2, £700 after month 3. So eventually the interest is calculated, and that's essentially the APR figure. The main thing that you need to know is the higher the figure, the worse for you, because the more interest that you're going to be paying and the longer it's going to take for you to pay that loan back. Couple of good things about loans. Good points are that you can, if you're buying a car or something with a loan, you have that equity. You can normally sell that car and then you can pay off your loan. You need to check with your loan provider whether actually there would be any penalty payments for early repayments and things like that. But if you've got quite a good credit score, a lot of car and hire purchase agreements, which we'll talk a little bit about later on, will be a lot higher actually than a loan that you could get from the bank. So some banks now, for example, Marks and Spencer's, are offering loans for as low as 3%, which is a phenomenally low price. You know, a lot of loans now and a lot of money and financing is incredibly cheap, and that's just a reflection of low interest rates and things like that with the bank. That's not to say they'll remain there forever. So consider a loan if you are considering a kind of hire purchase, but you'll need a good credit score to get a good loan rate, and that's one of the key things. Again, if you can, I'm talking about unsecured loans here, it's always going to affect your credit score if you don't pay them back on time. And ultimately, you know, if it affects your credit score and it's non-secured loan, you may struggle to get finance in the future, so that's something to bear in mind. The next one I wanted to talk about was credit cards. I've posted a whole video on credit cards, the link's in the description below if you want to check out more details on that. But ultimately, credit cards are good for financing your cash flow if you're struggling for cash on 1 month. And the reason is that you don't pay your credit card when you actually make that purchase. So what happens is you might have a credit card statement that runs from the 1st of, let's say, February to the 28th of February. That might be your statement period. So anything that you buy within that period of time is then normally paid around 30 days later. So actually you end up paying that maybe on the 31st of March. So what that means is it helps you in terms of managing your finance by basically saying you buy it now and then you can pay it at a later date. Now be careful on that, because obviously you need to make sure you've got the money to pay off the credit card. Credit cards should be paid on time, because otherwise you can get hit with extortionate credit card interest fees, which you need to be aware of. Check the video out in the link below if you want to find more details on credit cards. And the way that they work is essentially the banks make around 2.5%, so a 2.5% charge that they get each time someone buys something on their credit card, so they make money that way. A lot of credit cards have certain promotional schemes, cashback schemes and stuff, but I always recommend having a decent credit card. I think personally I've got 3, you get 0% deals on them. You've just got to manage them very carefully, and they are particularly good for cash flow, managing cash flow, particularly if you're short or you're strapped in 1 month. But bear in mind, you're always going to have to pay that back. You're going to accumulate interest if you don't pay it off in full, and you can run the risk of building up high levels of debt that you can no longer repay. That's not what we want to do. Okay, the next one we're going to talk about is quite an interesting one. I don't tend to use this, but it's an overdraft. Overdraft. My writing is terrible. An overdraft. Now an overdraft works, 2 types of overdrafts generally speaking. There's an authorised overdraft and an unauthorised overdraft. So the bank may say to you, you can have £1,000 and you will be charged when you go into that. If you go over the £1,000, that is classed as your unauthorised overdraft, and you'll be charged a penalty fee. Always stay within your authorised overdraft limit. Now overdrafts can be useful because they can help with cash. So sometimes you may need cash that you can't pay for on your credit card, therefore you can access an overdraft and you'll go into a negative balance essentially. A lot of banks, or some banks, for example I know First Direct, have a lot of interest-free overdraft limits. So they may say to you, okay, you can have £250, there'll be no interest on this amount, and you can take that and you can dip into that every now and then, and that will help with your cash flow if you're struggling in a certain month. So they're really useful from that point of view. Remember that you'll get paid back, and if you keep going into it and into it each month, eventually you build up and you'll end up going past this £250 and you'll end up getting charged on it. Overdrafts tend to work like this. So a lot of banks may say you've got a £1,000 overdraft and you'll get charged £1 a day every time you use it. That might be up to £5. Or they may say, actually, on this percentage of £1,000 we'll charge you 3.5% or even 10% maybe. The good thing about overdrafts is, in terms of the interest, is you're only paying interest on the balance for that day. So what will happen is, if you're paying 10% interest on the £1,000 and you pay off £100 of that, then your interest will be charged for that period of time and only £900. So the more that you're getting paid in, if you're regularly getting paid into an account and an overdraft, then the interest and rates will fluctuate, but you need to keep an eye on it. You can't just keep kind of dipping into it. Interest rates and things like that can build up, but helpful if you want some cash, you want to take it out on something that you can't pay the credit card with if you are ever struggling. As ever with all these kind of financing facilities, you need to be careful about whether you can afford the repayments, and don't get yourself into such negative equity that actually you can't afford to repay that overdraft back. Remember, there's always a cost to financing that you need to be aware of, and these should be used really as a last case resort. Another one that I wanted to discuss, generally speaking, is something called personal contract purchase. Sorry, I was just checking that it was personal contract purchase. You probably can't even read that, but personal contract purchase. Ultimately, PCP tends to be something that you would do on a car. It tends to work by paying a deposit. You then borrow a certain amount, a certain percentage of interest, and what you tend to borrow is the amount that car depreciates. At the end of your life of the car, perhaps you may have a balloon payment, they call it. So let's just take a car that costs £20,000. You might put £3,000 down. You might pay £7,000 over 3 years. The balance would be £10,000 that you would need to pay at the end of it, or you can give the car back, and it kind of depends on how much the car's depreciated and sort of gone down in value. And it's not a bad way to kind of finance cars and get new cars, But remember that even with this, don't be deluded by the fact that they might say to you it's £200 a month and you think that's great. There is an interest charge associated with purchase, PCP I should say. So remember that nothing is for free, and you need to take that into account. If the car was £10,000 for example, and you're going to do a PCP purchase deal, or for 7%, they can tend to be higher because they make money off it. You might be better going to a bank and saying to the bank, actually I want £10,000 at 3%, and over the life of the 3 years you'll end up paying the car off, and you'll end up paying a lot less interest at the end of it. The next one's quite a simple one. It's called HP, or hire purchase. This tends to be done on things like cars and photocopy machines for business and stuff, and the way it works is it's like a loan essentially, but you'll get financed by the institution. So you may have a loan that is borrowed against the car, and by Audi or something, if you were going to buy an Audi, you make the repayment. So if you do a hire purchase of £20,000, you put £5,000 down, the balance is £15,000, and you'll make monthly payments over say 36 months, and eventually you will have paid off the actual £15,000, and by the end of it you will own the car. Be careful, because until you've paid a third of that amount with the car, you actually, the showroom or the maker of the car, the owner, can actually repossess the car without a court order, and there's loads of different complications. But possibly that's another way to do it. It's sometimes easier to get credit through hire purchase, but you tend to pay a higher rate than you would do if you were getting financed by the bank.
Sega.